Are we at risk of a recession? It's been a question that a lot of people have been tossing around recently. We know there's a lot of uncertainties on markets. And so today we're going to dive into the risk factors for the economy. Before at the end, we'll talk about some of the bear market stats when considering the financial markets. To lay the scene at the moment, I think everybody's familiar with the fact that sentiment is at an incredible low. Financial conditions are tightening. We all know the horrid April that we've just come off the back of. It's been a really difficult uphill battle for the start of the year. We had the worst month for the Nasdaq since 2008, dating back to the GFC, which gives a little bit of the context of the state of how things are. Over 3/4 of the Nasdaq at the time of this recording are into a bear market. We know the S&P 500 is well into correction territory as well. Interestingly, we saw that the US GDP figure for growth was actually negative for the first quarter. Consensus estimates was for a gain, and we'll talk about what this can mean for growth and consumer demand later on in the video. It's worth noting that the VIX, the volatility index, is up above that 30 mark. It spiked. We've seen some significant one-day swings, both upwards and to the south side over the past week on markets. And really, what we're starting to see is the central banks are having quite an interesting time trying to navigate and ultimately land this soft landing as they try to curtail inflation, raise interest rates, and release the ultra-loose monetary policy back to more normalized conditions without, of course, invoking a significant slowdown and potentially sending the economy into recession. And so as we discuss some of the different risk factors for the economy with the way that things currently stand, I think first and foremost, it makes sense for us to unpack that inflation and interest rates discussion. Of course, they've been very much intertwined, but they are two distinct discussions as well. But first and foremost on the inflation front. As we know, inflation's running rampant. We're at 40-year highs for inflation. US CPI was 8.5% last month. Core CPI was up above 6% as well. Interestingly, core did not grow as much as possible, which actually gave a little bit of support for the market. But the market is now waiting to see the upcoming CPI numbers for this month up ahead. It's actually not too far away, and it will give further insight into the trajectory. And that real underlying question is, have we started to see peak inflation? With inflation running rampant at that 40-year high, we know that the central banks around the world, it's not only the Federal Reserve, the RBA kicked off over this past week. We know the Bank of England, RBNZ, Bank of Canada, and many others have begun raising rates. We had the first rate hike of the cycle with the Federal Reserve in March. The second rate hike just came through. It was hotly anticipated. A 50 basis point rise was delivered, lifting the federal funds rate to 0.75%. But there were some other interesting insights about what was handed down too. Firstly, Jerome Powell provided some indication that they didn't believe with the current way that things are, a 75 basis point rise was necessary. They gave a little bit of support for the markets. However, they did open up the possibility and provide the insights that it was likely that we could see further 50 basis points or similar rises in the coming months, which didn't surprise the market too much. We also got some discussions as well about the quantitative tightening. As we all know, for the backdrop, we've seen a significantly expansive period of monetary policy where there's been significant quantitative easing, the largest coordinated quantitative easing program we've seen globally. The Federal Reserve balance sheet has expanded to $9 trillion. So they've given us this insight about the QT, which will be commencing from June the 1st. There'll be a 3-month scale up, but at its peak, it will be $95 billion per month of unwinding of the balance sheet. 12 months in a year, that ends up around about $1 trillion per year. And as mentioned, that's coming down from the $9 trillion mark. But then on the other side of the coin as well, we know that there's inflation and interest rates will be risen to try and curtail inflation. But the Federal Reserve and other central banks don't want to inhibit and hamper growth. All things being equal, the economy looked in relatively decent shape. The economic recovery was continuing to go well. But of course, we've had some uncertainties over this past period. I guess it's worth noting for the purpose of our discussion, the recession definition. As we know, the technical definition of a recession is 2 negative quarters of GDP growth. And interestingly, in the US side, US GDP retraced by negative 1.4% for Q1. This was against all of the consensus estimates. Estimates were for around about a 1% gain. And so in fact, to answer the question at the title of the video, we would only need one more quarter in the second quarter of a retracement to enter into an official recession. But there were some interesting tidbits to take away from the GDP print. Firstly, consumer expenditure rose by 2.7%. You'll be interested to know that there was a 7.8% increase in prices. Of course, that ties into the inflationary pressures that we're seeing throughout the economy. However, there are a few other interesting factors as well that contributed, including declines in fixed investments and the record trade imbalance that weighed on growth. It's worth noting that economists and analysts, when they looked at it, by and large seem to look past this negative GDP print being noise rather than a clear signal of the economy heading into recession. But of course, it's definitely something to watch. As we talked about previously, the economy looked in good place. The economic recovery was strong. Of course, this was supported by ultra-loose monetary policy and significant coordinated fiscal support. We know that there was strong consumption being seen throughout the markets and a tight labour market as well. US unemployment is at 3.6%. Very strong tight labour market, which was one of the guidelines and the focuses that the Federal Reserve and other central banks were working towards. We know that household savings rates peaked during the pandemic. Of course, have begun to normalise now. But what will be very important on this growth side is consumer demand. So far, up to this stage, consumer demand has been resilient and strong. But we're going to be watching to see how they will pass through inflationary input costs, particularly as inflationary cost pressures persist if they do. If we're having a think about the recent earnings season that's just come and gone, Q1 basically across the board was relatively strong. We saw a majority of the cohort beating. Certain sectors, of course, had different types of dynamics playing out. But what I think a lot of the markets and the analysts will be watching will be how Q2 goes, particularly if these inflationary cost pressures stay. And as the producers, manufacturers, and the companies have to pass on these cost pressures, will consumers be able to continue to digest these, or eventually will we start to see demand destruction flowing through? And of course, it's not only growth and inflation and interest rates. We know that the geopolitical situation is another risk factor. Whether we're talking about supply chain bottlenecks, we've seen some of these potentially exacerbated by the lockdowns in China, or of course the situation in Europe with economic sanctions that are still having an active role, as well as of course supply chain bottlenecks that are flowing through everything that's playing out over in Europe too. We know that uncertainties are persisting throughout the market. There still is a lot of unresolved questions. We've started to get some insights and some data points, but from labour shortages to supply chains, inflationary pressures, there's still a lot of stories and chapters to continue to be written. And then I think something that's a bit more financial market focused rather than the broader macroeconomic discussion that we're having is valuations, but it's a worthy one that's worth discussing. We know that we've seen valuation compression across the markets in many of the key sectors, with unprofitable early stage technology and growthier names of the market really being top of the list. But what will be interesting and what investors continue to ask is, how far will this go? Have we seen enough valuation compression yet? Is this only still the beginning of it? We know it's much more sector specific, and we know that this past period has been much more of a stock pickers market versus the index driven gains that we've seen over the past couple of years. So it's going to be a fascinating period. I'd love to know your thoughts on it all as well. So drop in a comment below and let us know where you think things head. And so over this next period, we'll continue to watch for more data and inputs to come through, whether it's the economic growth numbers, inflation numbers. We're definitely set for an interesting time. There's still a lot of uncertainties. In terms of this bear market discussions, we know that we've entered into a correction on the S&P 500, the benchmark index. The Nasdaq, the more tech and growthier end of the market, we're into a bear market. As you know, the bear market definition is a 20% or larger retracement. Just some of those figures here. On the S&P 500 in the around 140-year history, we've had 19 bear markets. Average price decline is around 37% for those, with the average duration 289 days. So it gives you a bit of context about how things could look. If you are interested in the broader macroeconomic picture, here's another video that you can check out after this one. As we know, the focus for now will be central banks trying to navigate this soft landing. Ultimately, the question comes back to, can they raise rates and curtail inflation, bring in and inhibit this runaway inflation without sending the economy into the recession? We'll continue to watch. It's going to be a fascinating story. Thank you for joining us. For now, stay well and happy investing.